Hey, everybody, welcome back to another episode of Not Financial Advice. On today's episode, we're going to be using Grok AI to analyze Uber's stock right after this.
You need to diversify your bonds.
The only problem you're going to have is that you didn't buy more. Because by the time you read about it in the Wall Street Journal, it's already too late.
Okay, everybody, welcome back to the channel. I'll ask you to like the video and subscribe to the channel. And today we're going to take a look at Uber stock across a few different methods here to get an understanding of what is the fair value to pay for shares of Uber stock. Now, disclaimer, I own the stock. This is not financial advice. It's for education and entertainment only. So like the video, subscribe to the channel, and we're going to jump right in. So what is Uber? It's an app-based platform. It's in the utilities sector, but truly it's a technology stock, being app-based, being a reoccurring revenue model. And they have three main revenue segments. So there's mobility, which is ride hailing. There's freight. So they do some, like last mile delivery, which is a pretty small part of the business to my understanding. And then food. So delivery would be that revenue segment. So let's just jump right into it. So this is my real portfolio. I have $107,100 as a balance, beating the S&P 500 by 1.25 points year to date. And I'm literally putting my money where my mouth is because I own some Uber stock and I've done tremendously well. So we're going to look at it. And here it is. I've got $3,200 in Uber stock. I'm up 40%. I've only been in it for like 3 or 4 months. So I've made $900 in 3 or 4 months. Pretty cool for a guy like me. And current price around $95. I'm up 45 or 40%. So that means I have a cost basis somewhere like $65 or thereabouts. So that's really good. And I feel confident in that. But what is a good price to pay for Uber shares today? Now, a note on that. If you are seeking out information on a stock as a new investor, understand that whether you realize it or not, subliminally, the reason that you're seeking out information on a stock is probably because it's recently just done very well. Okay. I can't stress that enough, but we're going to learn together. So let's look at Qualtrim, a suite of software I pay for, not one I'm affiliated with. And we're taking a look at Uber Technologies. So right off the bat, current PE of 16, forward PE of 30, and 26, projected PE of 27 PE, which is actually pretty good. That means the earnings are pretty highly coveted. 27 is actually a pretty good number for a PE, at least in a bull market. Right around a 3% free cash flow yield adjusted for stock-based compensation. And they've got about a similar amount of cash and debt. So that's pretty cool. So we're going to look at it. Revenue over the last 5 years is up 25% year on year. Pretty great. Stabilizing to about 18% revenue growth over the last 1 and 2 years. So that's high revenue growth, 18% revenue growth. This is a good thing with Qualtrim. So you can see monthly active platform users going up and holding steady. Some of this data isn't. We're not gonna do this. Let's keep pushing. All right, free cash flow. So free cash flow. So free cash flow is after every single bill is paid. What do the owners of the company, aka the CEO or shareholders, how much money do we have that we can do whatever we want with? That's ultimately how stocks are valued in the long run. So they were burning money, but they've just had a sort of convincing turnaround. So you see like this boomerang. That's a pretty good sign. So 3.5 and 7 billion, about $6 billion of free cash flow averaged. But they do stock-based comp. So they pay executives with stock, with shares, which actually dilutes common stockholders. So you want to adjust it for stock-based compensation. So 5 billion and 1.5 billion. So that's like a little bit under 5, but that's not going to give you trailing 12 months. We need cash flow for the trailing 12 months. So let's switch this over to quarterly TTM. By the way, 20 years ago, you'd have to pay like $100,000 a year to have this level of financial data. Shout out to Joseph Carlson and Qualtrim, $10 a month, super worth it. So U-shaped boomerang thingy. I like to use 8 quarters for a lot of different financial metrics. It shows that a trend is changed if it's convincing and that it's convincingly moving in a different direction. So 8 quarters ago, they were flat on stock-based free cash flow and now up and to the right. I'm going to see trailing 12 months, 6 billion and 5 billion. So right around 5 billion or so of cash flow is what we're going to base our valuation on. So cash flow is looking good. I really like seeing that. Earnings per share, 8 months of them going up and to the right. When you go to earnings per share annually here, it's more ugly. But to be a disciplined investor, even though I get tempted by things, I wait until I see 8 months of revenue growth, free cash flow, and earnings per share. That's just like, I don't know where I got that from, but I do it and I think it's good. So you've got about the same amount of cash and debt. That's pretty great. Let's look at dilution. So do they just issue shares like out of the sky, helicopter money? Historically, they have a little bit, 11.5%. That's too much, but it's slowing down to about 3%, which is something that I've accepted. Stock-based comp. Looking at ratios. So we're going to go to returns on invested capital or returns on capital employed. Can they reinvest money profitably? It's been a challenge. They showed a hint of being able to do it there, 11% in 2018. Boomerang, really super couldn't invest money at a profit, pandemic things. And then 4, which is too low, and 12, which is still too low, but it's on the bottom of acceptable. And I'm seeing just that similar boomerang across everything. So they're starting to be able to reinvest profitably. So what that actually means is when you give them money to buy their stock, they're turning it into more money. So profitability is important. Gross margins are a little bit low. I guess maybe this is part of it being an industrial, but 40%, that's a little bit of a ding there. But gross margins, and I'll be frank, some of this is above my head, but here it is, profit margins. This is net margins on the bottom line, 22%. U-shape boomerang. Probably going to keep on getting better. All right, so like the video, subscribe to the channel. Now we're going to go over to, excuse me, we're going to go over to Grok. And so with over 4 years of investing experience, I was able to develop like a 15-page prompt to help Grok analyze stocks for me. And then I created that prompt, and then I used AI to refine the prompt, and then I used the AI prompt into AI to give us this report. That's part of why you should like my video and subscribe to the channel. Company overview. Uber Technologies is a global technology platform providing ride-sharing, mobility, food delivery, and freight logistics, freight services across 70 countries. So international diversification with an American-based company. We like that. 25 million Uber One members. So that's reoccurring revenue like Costco or Apple. We like that. That makes it sort of like a technology stock. ARR, annual recurring revenue. It's good. Innovations like autonomous vehicles. So think about Elon Musk and how divisive he is. Do you want a company like Uber that has network effects and is just about making money and has hundreds of millions of members, maybe 200 million members across the world, whatever it is, maybe more, maybe less, but they have a network in place. So they're able to turn on autonomous EV. I think they have a better ability to turn that on with their logistic and network effects than Uber, who just has the vehicles, but they don't have the customers. Uber has the customers. So this is where a lot of growth is going to come from for this company. It makes me excited about it. They face competition from Lyft and DoorDash. I think that Uber is the winner. Time will tell. And regulatory risk as well as macroeconomic challenges, just like every other company has macroeconomic risks for the most part, and all technology type companies seem to have regulatory risk. Economic context is macroeconomic stuff. Don't care about it. Most good investors don't. This is the data that it's pulled from all over the internet, but I showed you the data that I hold in the most high regard, which is from Qualtrim. We already reviewed all that together. So what I've had to do is do a mechanical valuation based on free cash flow adjusted for stock-based comp, as well as an earnings per share valuation, which you can see there. And then I had them blend it. And so, long story short, ta-da, stock's trading for 95. Grok 3 is saying that the shares are worth between $68 and $88. I think being in a secular bull market and with all the things, all the buzzwords, autonomous driving, and just sort of the preference for technology stocks and U.S. dominance, I'm more than happy to hold it, being quote unquote overvalued. Most overvalued stocks are ones that go on to do really well, especially in that like 27 PE range, 27 to 40 PE range. Companies that once lost money and now make money and are growing quickly and have a strong moat. Those are companies that often outperform. So what's it like being an exiled value investor in a secular bull market? You take valuations with a pinch of salt in either direction. So it talks about business quality. I already explained all of that. But let's go to competitive advantages, which is moat, which is important. 75% of U.S. ride sharing market. All right, it's over. They won. It's over and they won. And it says it doesn't have access to technical analysis, but I've actually set that up for you as well. So like and share the video. Again, Grok using about a 15% growth on the DCF as well as earnings per share, showing a fair value range of 68 to 88 on a $95 share price. And fortunately for me, I sleep so good at night. I'm around 68 or less for my fair value. Okay, we're gonna fact check it. So they say in efficient markets, they say that every piece of knowledge of stocks is priced in because of the knowledge of the whole world equates to what the fair. So that that view of markets, the efficient market theory, is say the current price is always a fair value. That's not true because of human emotion. So it's also near $100, which is also near all-time highs. I don't know exactly what this is, but this like crown thing, especially at getting higher, this is bullish. This is going to go past 100, I think. So that's cool if you want to make $5.50. Not financial advice, but if you look at the, let's just use the efficient. Let's use the. This is the convergence of the efficient market hypothesis and AI. So let's use AI to fact check AI. So I did a prompt into Chat GPT. Doing a free cash flow and EPS blended valuation on a bear base and bull multiple blended, adjusting for stock-based comp. Not sure what growth rate they used, probably 15. AI is pretty smart. A range between $79 and $118. So I think that's a pretty good answer. I think it's going to tend to trend a little bit higher. So I think that fair value is probably around 80 to $90 a share. Now here's the thing: if you bought the stock today, could it do much better than this? Yes. If you buy the stock when it's technically overvalued, sometimes that being a worst case scenario, if valuations were really cut and dry, okay, so you make $8 or 8%, you don't lose money necessarily, right? So we're just sort of seeing these ranges here between 79 to 118. So it's kind of just dancing all around there, but I think we learned a lot together about the stock today. And so if you enjoyed the video, like it, subscribe to the channel on the way out. And what you're going to see here is just a final view with some technicals. Red line is a 200-day moving average. Yellow is a 50. Green is a 20-day. And you see it crossing over there, which is super bullish. And then you can see the RSI, which is below 80, which it's around 60. So it's nearing overbought, but it's sort of dipping down there a little bit. All the things. Thanks for tuning in to Not Financial Advice. This is Sean. I'll see you on the next one.